Good afternoon to all of you and welcome to the ICICI Bank earnings call to discuss the Q4 2020 results. Joining us today on this call are Vishakha, Anu, Sandeep Batra, Rakesh Shah and Anandya. Thanks to everyone for joining us today. Team ICICI hopes that you and your family and your near and dear ones are safe and healthy. We would like to extend our gratitude to all the healthcare workers, sanitation workers, police, and other essential service providers and everyone who has continued to work to keep our society functioning and meet our daily needs for their immense contribution. Banking was categorized as an essential service to enable customers to meet their requirements in the physical space to the extent possible, as well as through digital channels. In these challenging times, our employees have shown strong resilience and the ability to adapt to changing circumstances. The health and well-being of our employees and customers and business continuity is of utmost importance to us. The bank formed a quick response team to take steps to protect the health of the employees and provide essential services to the customers. About 97% of the branches were functional with reduced working hours during the lockdown. The branches were staffed based on the customer footfalls and employees were rostered. Excluding the employees working at the branches and some of the team members from operations and IT, the majority of employees were working from home during the lockdown period and continue to do so. There is an ongoing thorough risk assessment for augmenting IT security controls and addressing any gaps and potential threats in the current working arrangement. ATMs across the country remained operational with an average uptime of about 98%. We've also deployed mobile ATM vans for the benefit of general public residing in and around the containment zone. Even in this challenging time, we are seeing opportunities to grow and strengthen our franchise. And we are using these opportunities to further accelerate the digital journey of the bank and our customers. In March 2020, we launched a comprehensive digital banking platform called ICICI Bank, which offers nearly 500 services to ensure uninterrupted banking experience to our retail, business banking, SME, and corporate customers. Many of these services are first in the industry and are available instantly on the bank's mobile banking platforms such as iMobile and InstaBill or the Internet banking platform. These include digital account opening, instant loans, payment solutions, investments in health and term insurance. Small business customers can also use the API from the recently launched API banking portal to integrate various payment and product solutions. We are seeing increased utilization of our digital channels and platforms by our customers and have ensured that our IT infrastructure is equipped, maintained to handle any surge in digital transactions. We continue to monitor the situation in the country and will take necessary steps to ensure the safety of our people and continuity of our business operations. In an effort to support the nation in its fight against the COVID-19 outbreak, the ICICI Group has committed a sum of 1 billion rupees, including 800 million rupees to the PM CARES Fund. ICICI Bank and ICICI Foundation have worked actively to assist various agencies, including hospitals, the police, paramilitary forces, municipalities, and other government bodies in their tireless efforts to safeguard the citizens of the country. While the first 2 months of Q4 of 2020 saw business as usual, the month of March was impacted by COVID-19. In Q4 of 2020, our core operating profits increased by 17.6% year-on-year to 71.48 billion rupees. For financial year 2020, the core operating profit grew by 21.5% to 268.08 billion rupees. The lower growth in core operating profit in the fourth quarter reflects the high level of interest on income tax refunds of 4.14 billion rupees in the corresponding quarter last year. Our deposit flows continue to remain healthy. Term deposits grew by 28.6% year-on-year to 4.2 trillion rupees at March 31, 2020, while average CASA deposits increased by 12% year-on-year in this quarter. The bank has been carrying substantial excess liquidity and the liquidity coverage ratio on a daily average basis for the quarter was healthy at about 125% outstanding basis at March 31 was even higher. Deposit flows have continued to be robust and liquidity has continued to increase in both March 31. The deposit flows and costs are reflected in the progressive reduction in our NCLR. The loan growth was impacted in March due to COVID-19. The domestic loan growth grew by 12.9% year-on-year at March 31, 2020, driven by retail loans, which grew by 15.6% year-on-year. The overseas branches portfolio decreased by 14.4% year-on-year in rupee terms and 21.7% year-on-year in US dollar terms as of March 31, 2020. The overall loan growth was 10% year-on-year. Coming to asset quality, gross NPA additions were 53.06 billion rupees this quarter. As you are aware, there have been certain developments with respect to a healthcare group based in West Asia and an oil trading company based in Singapore, where the borrowers appear to have been misrepresenting their financial position to lenders. Our exposure to both these accounts have been classified as non-performing and substantially provided for in this quarter. Going forward, we do not expect any further impact on the profit and loss from these accounts. Here, one would want to spend a couple of minutes on our overseas business. Since March 2016, the overseas branches loan portfolio has reduced by 50% in absolute US terms, and its share in the total loan portfolio has decreased from its peak of 24% in 2014-15 to about 8% at March 31, 2020. We have redefined our international strategy from financial year 2019 onwards to focus on non-resident Indians for deposits and remittances businesses with digital and process decongestion as the key enablers, deepening relationships with well-rated Indian corporates in international markets subject to a risk management framework, deepening relationships with MNCs and funds for maximizing the India-linked trade, fund flow, transaction banking and lending opportunities with strict limits on exposures, including reduction in the current exposures where required, and progressively exiting exposures that are not linked to India in a planned manner. Our provision coverage ratio in non-performing loans was 75.7% at March 31, 2020. We have made COVID-19 related provisions of 27.25 billion rupees against standard assets to further strengthen the balance sheet, which Rakesh will explain in more detail. Excluding the COVID-19 related provisions, credit costs were 206 basis points of average loans for quarter 2020 and 186 basis points of average loans for financial year 2020. The profit after tax was 12.21 billion rupees in the current year compared to 9.69 billion rupees in Q4 of 2019. For the full year, the profit after tax was 79.31 billion rupees compared to 33.63 billion rupees in financial year 2019. In line with RBI guidelines issued on April 17, 2020, the board has not recommended any dividend for financial year 2020. The CET1 ratio was healthy at 13.39% at March 31, 2020. The bank has undertaken a detailed analysis of its loan portfolio to assess the potential impact of the pandemic and economic disruption. As you would appreciate, we are currently in a period of high uncertainty, and any outlook necessarily involves a range of assumptions around constantly evolving variables. Hence, we would not share any specific numbers in terms of outlook. At a systemic level, and for us, there will be an impact on revenue and an increase in rating downgrades and NPA formation. However, based on our current assessment and the starting level of capital, operating profit and provision coverage on NPAs, as well as the COVID-19 related provisions that we are carrying, we expect to be well able to absorb the impact. We will continue building a granular book and lending to high-rated corporates. We are conscious of the importance of balance sheet resilience in a highly uncertain scenario. As we mentioned, our current capital position is strong. We would continue to assess this and look at further strengthening the balance sheet as opportunities arise. We see our digital and technology platforms as a key strength and the present scenario as an opportunity to re-engineer the delivery of banking. We are using this period to further strengthen our platform, our ability to capture market potential, and our delivery capabilities while enhancing efficiency. As mentioned earlier, we have seen a robust deposit flow post March 31, 2020, reflecting the strength and trust of our brand and franchise. Overall, the bank is well positioned to serve risk-calibrated opportunities that would arise in the coming times. At ICICI Bank, we are committed to building a sustainable and responsible business and creating a positive impact on the economy, society, and the environment. We have a board-approved environment, social, and governance framework which integrates the various policies and approaches of the bank with regard to ESG. Our activities around ESG are covered in the slides 43 to 47 in the investor presentation. The bank is committed to having an ethical and transparent relationship with all its stakeholders and making a positive impact on the society in which we operate and the environment. With these opening remarks, I will now hand the call over to Rakesh.
Thank you, Sandeep. I'll talk about the loan and deposit growth to start with. The overall loan portfolio grew by 10% year on year as of March 31st, 2020. The domestic loan growth was 12.9%, driven by a 15.6% growth in the retail business. Within the retail portfolio, the mortgage loan portfolio grew by 12.3% to 2 trillion rupees. Auto loans grew by 2.5%, business banking by 41%, rural lending by 13.8%, and commercial vehicle and equipment loans by 7.7% on a year-on-year basis. The personal loan and credit card portfolio grew by 40.7% year-on-year, off a relatively small base to 609.42 billion rupees, and is now 9.4% of the overall loan book as of March 31st. The domestic loan portfolio at March 31st grew by 2.1% over December 31st, 2019. Within this portfolio, the retail grew by 2.6% over December 31st. The sequential loan growth was lower than previous quarters. The SME business, comprising of borrowers having a turnover of less than 2.5 billion rupees, grew by 27.5% year-on-year to 228.51 billion rupees at March 31st. Growth of the performing domestic corporate portfolio was about 9.3% on a year-on-year basis. The bank is focusing on meeting the commercial banking needs of its corporate clients, including foreign exchange and derivatives, trade finance, payments and collections, as well as tapping opportunities across corporate ecosystems, including the supply chain and the employee. Coming to the funding side, we continue to focus on growing the daily average CASA balances. Average savings account deposits increased by 11% year-on-year, and average current account deposits increased by 14.9% year-on-year during the quarter. For the year, average current account deposits grew by 17.1% during FY 2020. Total term deposits grew by 28.6% year-on-year to 4.2 trillion rupees at March 31st. Coming to credit quality, gross NPA additions during the quarter were 53.06 billion rupees. The gross NPA additions from the retail portfolio were 12.94 billion rupees. Of the corporate and SME gross NPA additions of 40.12 billion rupees, 4.68 billion rupees represents the impact of rupee depreciation on existing foreign currency NPAs. There were slippages of 17.26 billion rupees from the corporate and SME borrowers rated BB and below at December 31st, 2019, which includes devolvement of non-fund-based outstanding to NPAs amounting to 0.32 billion rupees. The slippages from the BB and below rated portfolio included 5.86 billion pertaining to an account which was substantially recovered in the same quarter pursuant to a settlement. The balance corporate and SME NPA additions virtually entirely comprise the oil trading company and the healthcare group that Sandeep mentioned earlier. The provision coverage ratio excluding write-off continues to remain healthy at 75.7% at March 31st. Recoveries and upgrades excluding write-off were 18.83 billion rupees in the current quarter. There were recoveries and upgrades of 9.74 billion rupees from the retail portfolio and 9.09 billion rupees from the corporate portfolio. The gross NPAs written off during the quarter aggregated to 54.55 billion rupees. The bank sold gross NPAs amounting to 0.13 billion rupees during the quarter. The total net non-performing assets was 101.14 billion rupees at March 31st compared to 103.89 billion rupees at December 31st. The gross NPA ratio declined from 5.95% at December 31st to 5.53% at March 31st. The net NPA ratio declined from 1.49% at December 31st to 1.41% at March 31st. The loans and non-fund based outstanding to borrowers rated BB and below, excluding the NPAs, was 166.68 billion rupees at March 31st, compared to 174.03 billion rupees at December 31st and 175.25 billion rupees at March 31st, 2019. Of this, the non-fund based outstanding to non-performing loans was 50.63 billion rupees at March 31st, compared to 39.19 billion rupees at December 31st. The bank holds provisions of 11.82 billion rupees at March 31st against its non-fund based outstanding. The fund and non-fund based outstanding to borrowers under RBI resolution scheme was 15.33 billion rupees at March 31st, compared to 38.94 billion rupees at December 31st. The fund and non-fund based outstanding to restructured loans was 1.8 billion rupees at March 31st. The balance 98.92 billion rupees of fund-based and non-fund-based outstanding to borrowers rated BB and below includes 65.98 billion rupees related to cases with an outstanding greater than 1 billion rupees and 32.94 billion rupees related to cases with an outstanding of less than 1 billion. On slides 29 and 30 of the presentation, we have provided the movement in our BB and below portfolio during the quarter and for the full year. The rating downgrades from investment grade categories, excluding fund-based outstanding to accounts that were also downgraded to NPA in the same period, were 22.88 billion rupees in Q4. The downgrades were granular in nature in terms of sectoral composition. There were a few downgrades in the commercial real estate portfolio. There were rating upgrades to the investment grade category and a net decrease in outstanding of 12.97 billion rupees during the quarter. Lastly, there was a reduction of 17.26 billion rupees in Q4 due to slippage of some borrowers into the non-performing category and devolvement of non-fund-based outstanding to NPAs. The bank has operationalized the RBI guidelines on moratorium for borrowers as follows. Borrowers required to opt in for the moratorium, which included all eligible corporate and most retail and SME borrowers. Borrowers with automatic deferral who could opt out of the moratorium, which included select retail categories like commercial vehicles and rural loans, comprising about 11% of total loans. At April end, loans under moratorium across both opt-in and opt-out categories constituted approximately 30% of the total loans of the bank. The bank has made COVID-19 related provisions of 27.25 billion rupees against standard assets to strengthen the balance sheet. Based on the RBI guidelines, the bank is required to make a provision of 5% in Q4, amounting to 6.07 billion rupees on all loans overdue as of March 1, where moratorium has been granted. Loans that were overdue more than 90 days at March 31st and have not been classified as non-performing as per the RBI guideline of April were 13.09 billion rupees. The impact of classification of these loans of 13.09 billion rupees as non-performing on the gross NPA ratio at March 31st would have been 18 basis points. On these loans, the bank has made provision equivalent to that on NPA accounts, which is included in the COVID-19 related provision of 27.25 billion rupees mentioned earlier. The total outstanding provisions at March 31st, excluding provision for non-performing assets, considered in the computation of the provision coverage ratio, was 79.4 billion rupees or 1.2% of loans. These include the COVID-19 related provisions held against the non-fund based outstanding to NPAs, and general provision against standard assets as required by RBI guidelines and other standard asset provisions. Coming to the P&L, the net interest income increased by 17.2% year-on-year to 89.27 billion rupees, driven by both loan growth and an increase in margins. Interest on income tax refund was 0.27 billion rupees this quarter, compared to 0.16 billion rupees in Q3 and 4.14 billion rupees in Q4 of last year. Excluding the impact of interest on income tax refund, net interest income grew by 23.5% year-on-year in Q4. The net interest margin was at 3.87% in Q4 compared to 3.77% in Q3 and 3.72% in Q4 of last year. The impact of interest on income tax refund and interest collections from NPAs was about 4 basis points this quarter compared to 10 basis points in Q3 of 2020. The domestic net interest margin was at 4.14% in Q4 compared to 4.04% in Q3 and 4.12% in Q4 of last year. International margins were at 0.28% in this quarter. Non-interest income, excluding treasury income, grew by 15.8% year-on-year to 40.13 billion rupees in Q4. Fee income grew by 13.2% year-on-year to 35.98 billion rupees in Q4. There was some impact of the lockdown in the last fortnight of March. Retail fee income grew by 16.1% year-on-year and now constitutes about 75% of overall fees in the current quarter. Dividend income from subsidiaries was 3.38 billion rupees in Q4 of 2020 compared to 2.69 billion rupees in Q4 of 2019. The dividend income from subsidiaries was 12.73 billion rupees in this financial year compared to 10.78 billion rupees in FY 2019. In line with the IRDAI guidelines, asking insurance to conserve capital, ICICI General and ICICI Life have not recommended any final dividend for FY 2020. As a result, dividend income from subsidiaries is expected to reduce in FY 2021. On cost, the bank's operating expenses increased by 15.7% year-on-year in Q4. The employee expenses increased by 17.7% and non-employee expenses increased by 14.4%. The bank had 99,319 employees at March 31st. The provisions on retirement and other employee benefits have increased during this quarter due to declining yields in the current quarter compared to Q4 of 2019. For FY 2020, employee expenses increased by 21.5% on year-on-year and non-employee expenses increased by 18.3% year-on-year. Treasury recorded a profit of 2.42 billion rupees this quarter compared to 1.56 billion rupees in Q4 of 2019. The core operating profit increased by 17.6% year-on-year to 71.48 billion rupees in Q4. Excluding the impact of interest income on income tax refunds, the core operating profit grew by 25.7% year-on-year in Q4. For the full year FY 2020, the core operating profit grew by 21.5% to 268.08 billion rupees. Total provisions for the quarter were 59.67 billion rupees compared to 54.51 billion rupees in Q4 of 2019. These include the COVID-19 related provisions. There was no benefit of the relaxation provided by RBI in relation to making additional provisions required for extension and resolution period as per the June 7, 2019 circular. Excluding the COVID-19 related provisions, credit costs were 206 basis points of average loans for Q4 and 186 basis points of average loans for fiscal 2020. The profit before tax was 14.23 billion rupees in Q4 of 2020 compared to 7.82 billion rupees in Q4 of 2019. The profit after tax was 12.21 billion rupees in Q4 of 2020 compared to 9.69 billion rupees in Q4 of the previous year. The profit after tax was 79.31 billion rupees for the full year FY 2020 compared to 33.60 billion rupees in FY 2019. Regarding capital, as per Basel III norms, the bank on a standalone basis has a CET1 ratio of 13.39%, Tier 1 capital adequacy ratio of 14.72%, and total capital adequacy ratio of 16.11%. On a consolidated basis, the bank's Tier 1 capital adequacy ratio was 14.41% and the total capital adequacy ratio was 15.81%. Coming to some further information on the loan portfolio. Retail loans as a proportion of total loans were 63.2% as of March 31st. Including non-fund based outstanding, the share of the retail portfolio was 53.3% of the total portfolio at March 31st. The portfolio level build-up strategy for the retail loan book has been based on utilizing the existing customer database for sourcing in key retail asset products through cross-sell and upsell. The underwriting process involves a combination of key variables to assess the cash flow and repayment ability of the customer like income, leverage, customer profile, affluence markers, bureau data, and demographics. The bank utilizes multiple data points from the ecosystem, including liability and asset relationships, transaction behavior, and bureau behavior, along with proprietary machine learning and statistical models for credit decisions. The bank also leverages on the strong analytical capabilities for finer risk segmentation of customers based on internally developed scorecards and models, which help in achieving superior categorization of delinquency identification. The bank carries out regular benchmarking of its major retail portfolios with industry through credit bureaus, and the delinquency metrics has generally been better than the industry for all major regions for us. We continue to monitor the performance at a sub-segment level, and in view of the current operating environment, we have reviewed the customer selection and underwriting norms and carried out necessary policy strengthening at micro-market and sub-segment level. Our mortgage portfolio was about 49% of the retail loan portfolio and about 31% of the total loan portfolio at March 31st. Home loans comprise about 70% of this portfolio, and the balance is predominantly loans against property. The home loan portfolio is granular in nature with average ticket size of about 3 million rupees. It is geographically well diversified and has been built on fundamental premises of cash flow assessment of the underlying borrower, as well as meeting the legal and technical standards of the bank for the property being mortgaged. The average loan-to-value ratio for the home loan portfolio is about 65%. The loan against property portfolio has conservative loan-to-value ratios, and lending is based on cash flows of business or individuals with limited reliance on the value of collateral. The valuation of the property is carried out internally. The average loan-to-value ratio of the loan against property loan portfolio is about 55%. Auto loans and commercial business loans, which include commercial vehicle financing, account for 5% and 4% of the overall portfolio of the bank, respectively. The commercial vehicle portfolio across banks, including us, had seen an increase in delinquency even before the outbreak of COVID-19, and the situation is likely to deteriorate further due to lockdown across the country. However, it may be noted that generally the economic life of a commercial vehicle or a construction equipment is much higher than the tenure of the loan. It has been seen during past cycles that vehicle and equipment owners repay dues as and when the assets start to generate profits in tandem with economic recovery. The growth in the auto loan portfolio across banks, including us, has declined over the last 2 quarters due to decline in the passenger car space. Our personal loan and credit card portfolio is about 9% of our total loan portfolio. We have grown this portfolio from a low base primarily through cross-sell. About 70% of the personal loans and credit card portfolio is to the existing customers of the bank, which provides strong liability information for credit assessment. Around 85% of the portfolio comprises salaried individuals. About 75% of the customers in the salaried segment are employed with well-rated corporates, including MNCs and government entities, and have stable income streams. The delinquency rates for the remaining customers in the salaried segment are only marginally higher than the rest of the portfolio. This can be attributed to conservative underwriting norms in terms of higher income cutoff, lower leverage norms, loan caps, and other such things done by the bank. The self-employed segment in these portfolios is about 15%, and while this segment could be more impacted in the current environment, the proportion of customers in highly impacted sectors like restaurants and travel and tourism is generally low. The rural portfolio comprises 9% of the total loan portfolio. Within this, gold loans are 2% and Kisan credit cards are 3%. We and other banks have been highlighting the high delinquencies in the Kisan credit card portfolio for the last several quarters. Our overall microfinance loans directly done by the bank are very small and niche. Our business banking portfolio accounts for 4% of the total portfolio. It comprises small business customers with an average ticket size of 10 to 15 million rupees. The relatively high growth in this portfolio reflects the low base and market share. Our focus in this segment is on parameterized and program-based lending, digital channels, granularity, collateral, and robust monitoring. About 85% of the portfolio has a collateral cover of more than 100%. About 87% of the portfolio qualifies for priority sector lending for the bank. The delinquency trend in this portfolio has generally been low. The corporate, overseas, and SME portfolios were 36.8% of the total loans at March 31st. Including non-fund based outstanding, the share of the corporate, international, and SME portfolio was 46.7% of the total portfolio at March 31st. The SME portfolio, comprising exposures to companies with a turnover of up to 2.5 billion rupees, was 3% of total loans. In the past, the bank has experienced high NPLs in this portfolio. In recent years, the bank has reoriented its strategy in this portfolio towards granularity, collateral security, and more parameterized lending. The international loan portfolio was at 8.4% of the overall loan book for the parent bank at March 31st. Excluding exposures to banks and retail lending against deposits, the corporate fund and non-fund based outstanding at March 31st, net of cash, bank or insurance bank lending, was $7.48 billion 63% of the outstanding was to Indian corporates and their subsidiaries and joint ventures. 16% of the outstanding was to non-India companies with Indian or India-linked operations and activities. The portfolio in this segment is well rated, and the Indian operations of these companies are target customers for the bank's deposit and transaction banking franchise. The bank would continue to pursue risk-calibrated opportunities in this segment. 7% of the outstanding was to companies owned by NRIs and PIOs. 14% of the outstanding was to other non-India companies, which is about 1% of the total portfolio of the bank. We are planning significant reduction in this portfolio. While the outstanding to Indian corporates and their subsidiaries and joint ventures has remained at a similar level compared to the previous year, the balance portfolio has reduced by about 30% year-on-year at March 31st. The builder portfolio, including construction finance, lease rental discounting, term loans, and working capital loans, was 223.18 billion rupees, or about 3% of our total loan portfolio. The real estate sector has been under stress even before the outbreak of COVID-19 due to slow sales, cash flow mismatches, and funding constraints. The lockdown on account of COVID-19 is expected to cause delays in respect of project progress and sales. Our portfolio is generally granular in nature, with the larger exposures being to very well-established builders. About 12% of our builder portfolio at March 31st was either rated BB and below or was classified as non-performing. The total outstanding to NBFCs and HFCs was 397.55 billion rupees, or about 5% of our total loans at March 31st, and the details are given on slide 32 of the presentation. Our exposure is largely to well-rated entities with long vintage PSUs and entities owned by banks and their established corporate groups. The proportion of the NBFC and HFC portfolio internally rated BB and below or non-performing is about 2%. Coming to our non-fund-based exposure, we would like to highlight that the notional amount of derivatives and swaps represents over 90% of the amount reported as contingent liabilities in the financial statements. Since 2016, we have focused on shifting from non-fund-based exposure to fund-based exposure, even as we continue to consider all types of exposure for our credit assessment and limit setup. The outstanding amount of letters of credit and bank guarantees has declined over the last 4 years, while the total advances of the bank have grown by a CAGR of about 10%. As a result, the outstanding amount of letters of credit and bank guarantees are about 22% of total advances at March 31st, 2020, compared to 34% at March 31st, 2016. Overall, our approach to the corporate portfolio since 2016 has comprised improvement in the incremental rating mix, with 80 to 90% of fresh disbursements being to clients rated A- and above, reduction in concentration risk, particularly in lower-rated borrowers, reflected in the reduction in share of top 20 borrowers in the portfolio, substantial improvement in the rating profile of top exposures, and a much more granular lower-rated portfolio. Other than 3 accounts, one each in the telecom, power, and construction sectors, the maximum single borrower outstanding in the BB and below portfolio was less than 6 billion rupees at March 31st, 2020. The fund-based outstanding of the construction account is classified as non-performing, and its non-fund-based outstanding is part of the BB and below portfolio that we disclosed. The reduction in specific type of exposure such as project implementation risk, equity shares, assignment security, and low visibility of cash flows are the exposures that we have reduced over this period. We have shifted from non-fund to fund-based exposures, even as we continue to consider the entire exposure for our risk assessment and limits, and have focused on sell-down, indication of origination to other market participants. Over the last 2 years, our focus has shifted from loan growth to serving the entire ecosystem of the corporate client, including its employees, business associates, and the supply chain. As Sandeep mentioned, the bank has undertaken a detailed analysis of its loan portfolio to assess the potential impact of the pandemic and economic disruptions. This involved assumptions on the time to normalcy of the environment, assessment of resilience of the borrower based on income or profit, leverage, rating or credit score, level of fixed cost, market reputation, liquidity on hand, and ease of restart of the business. An assessment of the COVID-19 induced risk intensity, including the industry, the nature of the market, volatility levels in the specific segments, and complexity of the business. For the retail portfolio, other than business banking, risk markers based on credit score, leverage, and loan to value, as well as categorization of employers for salaried borrowers, and inputs from analysis of customers under moratorium were considered. In the rural portfolio, the analysis was based primarily on assumptions of drop in collection efficiency, For the SME and business banking portfolio, factors such as collateral, industry, location, and other credit markers were considered. For the corporate portfolio, the bank has conducted a borrower-specific analysis covering a substantial part of the portfolio. In respect of NBFCs, HFCs, the analysis took into account available liquidity, collection assumptions, promoter support, and ease of refinancing. For the real estate developer portfolio, assumptions on rentals and cash flows were considered. At March 31st, the bank had 75.7% coverage against existing NPAs. The total outstanding provisions at March 31st, excluding the provision for non-performing assets considered in the coverage ratio, was 79.4 billion rupees or 1.2% of loans as we discussed earlier. The bank's CET1 ratio is comfortable based on all the above, our operating profitability and our current assessment. We would be well able to absorb the impact of the potential stress induced by the COVID-19 pandemic. Coming to the subsidiaries, the details of the financial performance of subsidiaries is covered in slides 38 to 39 and 65 to 70 in the investor presentation. I'll briefly talk about the major highlights of the unlisted subsidiaries. The profit after tax of ICICI AMC was 2.17 billion rupees in the current quarter, at a similar level compared to last year. ICICI Bank Canada had a loss of 7.5 million Canadian dollars in the current quarter, compared to a profit after tax of 22 million Canadian dollars in Q3 and 12.6 million Canadian dollars in Q4 of 2019. The loss in the current quarter primarily reflects the increase in expected credit loss provisions under IFRS 9 due to change in the macroeconomic outlook arising from COVID-19. For the full year, the profit after tax was 40.6 million Canadian dollars compared to 52.4 million Canadian dollars for FY 2019. ICICI Bank UK had a net loss of $6.8 million this quarter compared to a net profit of $8 million in Q3 and a loss of $25.3 million in Q4 of 2019. The loss in the current quarter reflects the collective overlay provisions related to COVID-19. For the full year, the profit after tax was $23.2 million compared to a net loss of $52.9 million for FY 2019. The focus for the overseas subsidiary is similar to that for the branches, primarily around NRI and India-related opportunities. The non-India corporate portfolio of the subsidiaries has reduced over the last 1 year, and we are working on a further plan reduction going forward. ICICI Home Finance had a profit after tax of 0.64 billion rupees in the current quarter compared to a profit after tax of 0.03 billion rupees in Q3 and a loss of 0.03 billion rupees in Q4 of 2019. The consolidated profit after tax was 12.51 billion rupees in Q4 compared to 46.7 billion rupees in Q3 and 11.7 billion rupees in Q4 of 2019. The consolidated profit after tax for the full year was 95.66 billion rupees compared to 42.54 billion rupees. With this, we come to a conclusion of our opening remarks, and we'll now be happy to take your questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star then 2. Participants are requested to use handsets while asking a question. Anyone who wishes to ask questions, please press star then 1. The first question is from the line of Mahrukh Adajania from Elara Capital. Please go ahead.
Yeah, hi. So is it fair to assume that of your total 27 billion of provision, 8 billion is either RBI mandated or NPL provisions, that is accounts that would have become NPL, and 19 billion is broadly on completely standard loans?
So of the 27.25 billion rupees, as we said that, about 6 billion rupees is the minimum, provision required as per RBI based on 5%, provision requirement which is there at March 31st. So the rest of the, of course, all these provisions are on the standard overdue loans, as of March 1st. Out of that, as we have said, about 13 billion rupees of loans, where we have granted moratorium, that would have crossed 90 days at March 31st, and they have been kept standard as per the benefits, given by RBI. So if you look at the 27.25, if we were to go strictly by, say, the minimum provision that RBI requires as per the April 17 circular, we would have done provisions of about 6 billion rupees for the quarter.
Okay. And in terms of your slippage, the healthcare account, that would also be domestic or international?
That was in our overseas book.
So that was also overseas only, right?
Yes.
Okay. And just in terms of the moratorium, would you be able to give any color on how the moratorium looks like in personal loans, unsecured loans, and the SME book?
So the moratorium, as you know, it has been given by RBI given the current situation where the borrowers whether they are of the highest credit standing or of low standing would look at opportunities to conserve on their cash flows. So we have seen borrowers from across geographies, across product segments, across customer categories who have opted for taking the benefit of the moratorium. So it's something which is actually quite well spread across portfolios. So there's nothing specific that one will be able to conclude from looking at each of the segments. As we mentioned earlier, that indeed for some of the portfolios like the commercial vehicle portfolio, some of the rural portfolios, the two-wheeler portfolio, which is a small portfolio for us, we had a opt-out kind of an option for the customer that we gave by default a moratorium, and the customer, if he came back to say that they did not want the moratorium, then we exclude the customer from moratorium. So that's how it has played out, and that's what aggregates to about 30% for us.
Okay, sure. And just one last question in terms of your international book. Now, you did mention that the size of the largest account except for the size of account except for the three you mentioned is 6 billion, right? 600 crores.
That was for the double B and below portfolio. Double
B and below, yes. So just in terms of the international loans, because the commodity cycle is very weak, would there be a lot of stress on the international book, the remaining international book, or would those downgrades have already happened in 4Q?
So I take it as look at the rating profile that we have given for the portfolio and the double B and below. Indeed, that may not capture the full impact of what may happen under COVID. That is not something which would have already completely been factored as of March 31st. So that is generally true for the entire portfolio for us, and I'm sure for other entities as well. Within the overseas portfolio, I think over the last 12 months, 15 months, we have been pretty focused in terms of our approach, and Sandeep outlined our approach and focus on the non-resident Indians and other India focused business. We have had a local lending portfolio in the past, and we have been working to bring it down, and we did reduce that by about 30% during the year, including wherever we have been able to get cash collaterals or get guarantees from other banks or credit insurance, all of that, and we would continue to reduce that further. But I would not say that there is any specific large worry that we have on the portfolio. It was indeed unfortunate that in the March quarter, we have had these two instances, and they are in the overall scheme of things material for us. That's why we have called them out in our presentation. In both of them, they were both for us investment grade loans, and we were not surprised with the outcome which happened in terms of the financial misrepresentation. So that kind of clearly tells us that we should kind of be even more proactive in bringing this portfolio, which is not core to our strategy. That I think is very clearly established by us internally across businesses over the last 12 months. The only thing is that on the existing portfolio, we could have been more proactive in terms of bringing that down. That's something that we will look at going forward. But I would not say that there is any specific worry on the portfolio, per se. And I gave you a color of the portfolio as well to say, 63% of the fund and non-fund based outstanding, net of all the, the cash-like collateral that we have, is to Indian corporates and their subsidiaries and joint ventures. So it's already at 63%, which would have been maybe a bit lower, in March 19. That's how we are looking at this portfolio.
Thanks a lot. Thanks.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference call, please limit your questions to 2 per participant. For any further questions, you may come back for a follow-up. The next question is from the line of Prashant Poddar from ADIA. Please go ahead.
Hi, Sandeep. Hi, Rakesh. Hi, everyone. Quickly, one clarification. So the provisions, outstanding general provisions, which is excluding the standard provisions on assets, is about 50 billion. Is that fair?
No, sorry, Prashant, just come again. What is the...
So there are 2 types of...
Excuse me, this is the operator. The current participant has put the call on hold. We take the next question from the line of Bhavik Dave from Nippon India Mutual Fund. Please go ahead.
Hi, good evening, sir. Sir, my question is regarding the mortgage book, where you clarified that 70% of your book is home loan. I just wanted to understand on the home loan front, what proportion of the book would be to customers where they haven't got the property in hand, like the property under construction, and they have taken a loan. And if you could provide some more color on your mortgages, on what proportion of the customers are asking for a moratorium on the mortgage side.
So you were not very clear, but from what I understood, on the home loan portfolio, we have not given a separate breakout in terms of the under construction properties. It will be a part of our overall portfolio. I don't think we will be we would broadly be in line with the market or slightly lower than the market is what we believe on that aspect. I could not get the second part of the question.
So second part is, sir, on the moratorium front, is there any specific number that we are giving out for retail because retail has been a focus area? Is the moratorium very different in the retail segment?
So, in the retail segment, even in the corporate segment, we have had, borrowers, who have, opted for, the moratorium. Because, frankly, if you look at it, it is at the normal interest rate and it's like an additional line for you. So at these times, we have seen even, corporates opting for, moratorium. And for retail also, there have been a fair number of customers, and that's the aggregate, 30% which is there. As I said, it is, broadly, quite well spread across the portfolio. It would, of course, be higher for the portfolio where we had a, default moratorium option, which I talked about, the commercial vehicle portfolio, parts of the rural portfolio, and two-wheeler loans. Rest of it is quite well spread across each of the portfolios.
And so lastly, on your personal loans, which is, reasonable growth momentum, although of a smaller base, can you provide some more color on the personal loans? Where what percentage of our customers would have a liability or a savings account with the bank, or any other color on the personal loans?
Like I mentioned on the, about 70% of the personal loan and credit card portfolio is to the existing, customer base, of the bank. And that overlap will virtually be, on the liability side. So they would largely have savings account with us. So that is the number, that you could look at that.
Okay. Thank you.
Thank you. The next question is from the line of Prakash Kapadia from Anived PMS. Please go ahead.
Thanks for taking my question. I had two questions. On mortgage has been a big driver to our growth. So what is the kind of, growth we are looking at? Because that's a large part of our retail book and the overall book also at 2 trillion. Given the uncertainty due to, COVID, what are we seeing or what is our sense on residential segment as an asset class? And, if you could give some color of, top 8 cities to our book, that will be helpful. And secondly, in terms of, our cross-sell on personal loan and credit cards, are we cutting the limits for risky customers? What is the cross-sell ratio? To give some color that we helpful.
So on the mortgage portfolio, actually, even if you look at more generically, it's fair to assume that over the last 6 weeks or so, I don't think much of bank lending has happened at all. I talked about our approach across the retail portfolio. Indeed, mortgage loan is a very important product for us, and we find it to be a very sticky product. So once you get a customer with a mortgage and a savings deposit account, you can have a long-term relationship. So it will continue to be a key product. In terms of growth, I think it will be a function of all the factors that we talked about while discussing the COVID-19 in terms of how soon the lockdown gets over, how soon the economic activities resume, and all the other such related things. So what we can say is that we will be focused on this segment. We will be if you look at the approach in the last 2-3 years, nothing would change going forward. Of course, from a risk assessment point of view, there are some things that we will fine tune given the current environment. On growth number itself, it's very difficult to give any number on mortgage or the rest of the portfolio as well. Your second question on personal loan and credit card was related to. On the cross sell, yeah, so there, again, like I said, 70% of the PL and card business has been coming from existing customers of the bank, and that focus will continue to be there in the future. If anything, would get even sharper than where we are right now. Of course, as we speak, it's not that we are doing a large amount of business on the personal loan side. On credit card, wherever we have existing customers of the bank and we have pre-approved limits. Of course, we have tightened all those limits compared to where we would have been a couple of months back. We are quite happy to issue fresh credit cards also. So that is how we would look at it. So overall, I think we are happy to do business, but indeed we have tightened the credit risk filters in the current time.
And any number you can share on the cross-sell ratio as of now, or the number in terms of the mortgage book contribution from top 10 cities will be helpful?
We have not disclosed that separately. The way we track cross-sell actually is what I said, that 70% of the business is coming from the existing customers of the bank.
Okay. And lastly, we had targeted a ROE of 15%. Does that stand true given the uncertainty, or will get deferred by 6-8 months, 1 year, our overall sense?
Again, as Sandeep mentioned, given the uncertainty in the environment, we would not be in a position to comment on a specific outlook in this regard. I think it is fair to assume that there will be an impact on credit demand, on our loan growth, on fee revenues. There will be some increase in NPA additions, credit losses. So I think the focus in the next 6-9 months for us would be on balance sheet preservation, on ensuring we are well capitalized, have a high level of liquidity buffer, and also use this opportunity to further strengthen our customer franchise, deposit franchise. I think there's a lot of opportunity there as well. So on the ROE, we will see. I think we'll be able to assess that once we have clarity on the post-COVID situation.
Sure. Thanks. I'll come back if I have.
Thank you.
Thank you. The next question is from the line of Rahul Jain from Goldman Sachs. Please go ahead.
Yeah, hi. Good evening, everyone. I've got 2-3 questions, but I'm limited to only 2. Number one is just wanted a clarification on this provisioning that you made on COVID side, Rakesh. So this 13 billion rupees that you talked about, where you have granted moratorium, which otherwise would have split into NPA, you said you made 100% provisions against this under this COVID provision. Did I get it right?
No. I said that against that 13 billion rupees, we have made provisions as if they were NPA.
Okay.
Yeah, so 100%. So we have made, if they had become NPA at March 31st, if this April 17th circular was not there, the provision that would have been required is the same provision amount that we have made on these loans, and that is a part of the 27.25 billion.
Understood. And this 13 billion would all be on account of retail loans, or there would be corporate also?
It would not all be retail, but predominantly I would say it would be retail.
Got it. And you said that 30% of the customers have applied for moratorium. This is as of what date? Or is this as of end April or at this point of time?
This is as of end April.
Okay, got it. And just one more thing, is it possible to get a color in terms of what would be the bureau score of these 30% of customers who applied for it, particularly in the retail? Will it be above 750, between 700 and 750? Any color on that, qualitatively?
We have not disclosed anything specific on that now.
Okay. The other question is, just wanted to know what would be a strategy and provisioning now going forward?
Sorry, what is that?
Strategy and provisioning going forward over the next couple of quarters.
On provisioning, like we said, I think over the last couple of years, our approach has been very clear that we would want to be conservative in terms of provisioning, recognition. I think we have tried to be that if a problem comes up and we kind of see that recovery will be a challenge, we have classified accounts upfront. We had one in the December quarter. Couple of ones which we have done in the current quarter technically may not have been 90 days overdue. So that approach is very clear. And once an account is NPA, also we try and take provisions, which are appropriate. So we would definitely want to keep our coverage ratio at a comfortable level. So today, of course, we are at a pretty high level, partly because the past the cycle of the corporate NPL with the aging, we have increased the provisions there a lot. So we are at 75%. But clearly, for example, if I go back, 2-3 years, we were, as low as 50% or below that on coverage ratio. There is, no way that we'll go down to those kind of levels. We have, put in place a board approved policy for a certain minimum, coverage ratio, as well. So that is on the NPA side. On the standard asset, of course, in addition to whatever we are required to do as per RBI, we have taken this, 27.25 billion rupees, out of which, like I said, 6 billion would have been the minimum as per RBI based on 5%. If you make it 10%, then also by June would have been 12 billion rupees. The rest of the 15 billion rupees is clearly additional, provision, contingency kind of provision that we have taken at March 31st. The actual requirement of provisions over the next, couple of quarters or this current financial year, we'll have to see how that plays out. But in general, we will want to, continue with a, conservative approach on the asset quality and the provision aspect.
Got it. Thanks a lot, Rakesh.
Thanks, Arun.
Thank you. The next question is from the line of Anand Ladha from HDFC Mutual Fund. Please go ahead.
Hello, am I audible?
Yeah.
So a couple of questions from my side. So few data points and if you can share your outlook. So in fact, look at our NIM, it has consistently improved from 3.5% in the domestic side to today almost like 4.15. If you can share an outlook, given the environment where the pricing power are again with banks, do you expect this thing to stable or improve from here on? Second, if you can give some color on cost income ratio side. This year, our cost growth on the employee side, as well as on the other OPEX side was fairly strong. So what's the outlook of the same? And if you can share what...
Yeah, we can. I'll just take those two. Anand, I'll lose track of the questions. I'll take those two and then we can do the next. Yeah. So on the net interest margin, I think the funding franchise, which we have had, the benefit of the growth in, not just the CASA deposits, but the retail term deposits. You would have been seeing our retail, deposit rates, virtually being the lowest among private sector banks. At most times, we have been leading the reduction in rates. Even savings deposit rates, we have, cut. So we are, focused on margins. Of course, in the current context, you will have to take into consideration that the liquidity that we are having is much higher than normal levels. And that is, a large part of that is by design. Part of that is because there is not as much of, credit demand, as well. It will have, some impact on the margins, going forward, for sure. We have reduced our MCLR. You would have seen from May 1st by 25 basis points. Some of our loans are linked to repo rate. So as the repo rate has come down, some of the yields there will go down as well. So to the extent possible, we will try and manage that with lowering our funding costs. But at some stage, beyond the level, you will not be able to do that. So that's how we are looking at it. The other thing has been that on the business side, each and every business segment has been extremely focused on pricing of loans, and that also has kind of benefited us in terms of giving us that extra 10-20 basis points on the asset yields across portfolios. So that focus will continue, but it's absolutely fair to assume that in the near term, the pressure that will be there on the margin coming from the surplus liquidity, lack of loan demand, and the lower rates always mean that the CASA float benefit comes down. So some of that will be there directionally, but we should look at the fact that over the last year or two we have been able to improve our NIM quite meaningfully. On the cost to income ratio, I think FY21 we will have to see how the income kind of shapes up. It will again be a function of the lockdown period and the time it takes to recover from there on. So it's difficult to say. On the cost side, you would have seen that this quarter the cost was more clearly somewhat lower than the trend that we have seen in the first 2-3 quarters of this of FY 2020. I think going forward we'll have to focus both in terms of the leveraging the investment that we have done in terms of the increase in employees, increase in branches, and get outcome from there. Sandeep talked about all the efforts that we are making on the digital side and new ways of customer acquisition that we have been working on and servicing the customers. So on the cost side, both the employee cost clearly compared to say FY20 incremental hiring will not really be there in the current context. So some of those benefits will come in, but some of the costs like technology and all we will continue to invest through this period. So that is something which clearly is giving us a competitive edge, and on that side we will continue to make investments and expenses. So sorry for the long-winded answer, but the focus will be to bring down costs, but on a cost income ratio there is no specific number that we are kind of looking at.
Well, perfect. But if you can articulate a 2-year, 3-year cost income ratio strategy, probably the peer bank are at 37, 38%, we are at 43. The gap is almost like 5-6%. So is it fair to assume that at some point of time this gap will again narrow down? Like we have seen narrowing of gap in the margin side.
No, so the gap can be narrowed in in many ways, but what we would want to do is that whether that gap narrows or even widens. As long as the core operating profit of the bank is increasing on a risk-calibrated basis, we are quite fine. So to that extent, we could narrow the gap by reducing some investments and all of that, maybe do less of business that consumes more cost. But as we know, we have discussed in the past, the focus in the bank across each of the businesses is to maximize core operating profit on a risk-calibrated basis. So we are not so focused on particular ratios per se. But yes, directionally, I think clearly there will be benefit will come from technology. But we see that benefit to come in more from enhancing revenue opportunities rather than just plain cost cutting.
Perfect. And just data point, within our mortgage book, what proportion could be LAP?
About 30%.
30%. Okay. And lastly, on the UK and Canada subsidiary, we reported loss. What's happening in both the subsidiary and what's our strategy going forward? As we had clearly indicated that in the domestic book, we will keep on reducing the international loan proportion. So what will happen these two subsidiaries?
So in both these subsidiaries, Anand, I gave the specific reason, actually the reason why they got into a loss position was because of the provision required because of COVID-19. So for example, ICICI Bank Canada, they are on IFRS 9. So they have taken a higher expected credit loss provision based on the impact, the potential impact of COVID-19 and the slowdown in the growth and all has to get reflected in the probabilities of default that they consider for their stage 1 and stage 2 portfolios. Similarly, ICICI Bank UK, under UK GAAP, has taken an additional collective, provision because of COVID-19. So that is the reason, for the loss in the particular quarter. We were quite happy to note that UK, came into profit, after, a gap of, couple of years. Canada, if you look at the earlier 3 quarters, has been, profitable. They have declared, dividend. A part of our dividend income for the quarter has come from, Canada. So our focus again for overseas subsidiaries will also be similar to what is there, at the branches to focus on NRIs and India-linked businesses. We do acknowledge that as part of the subsidiary, there will be local business that we will do, which will be more than what we do in the branches. But the overall focus will be that I don't think you will see much of a balance sheet growth. Capital conservation will be the key, there as well. And on the portfolio, we do give some breakup, in our presentation.
Thank you. Thank you. That's from my side.
Thank you.
Thank you. The next question is from the line of MB Manish from Kotak Securities. Please go ahead.
Hi. Just one question from my side. Have you made any reassessment on the capital side, given the post-COVID scenario? Thanks.
Yeah. So, in terms of, capital, as you would assume in the current scenario, something that, one would, regularly kind of, keep reviewing. You look at our current, CET1 ratio at, 13.39%. You factor in, the operating profit trajectory, that we have had, for the last few quarters. And, also the fact that what does happen at these times is that there is a lack of credit demand and the loan growth, actually slows down. So the capital consumption pace also, comes off, during this period. So those are the factors that will be the positive. I think, no declaration of dividend is also helpful in this kind of a situation, per se. There will be, pressure because of, the profitability kind of getting impacted and, the potential credit losses. So as of now, we believe that we are, pretty well placed, to kind of absorb the impact which could potentially be there from COVID-19, given the starting level of capital which is there and the operating profit, which we have.
That is the only reason why we are asking is that we have seen a situation on the ground where we really don't know what is the good level of capital for a bank. That's the broad point. We've seen stock prices being very erratically for even some of the reasonably well capitalized firms when they enter into some problem. That is the reason why I had asked.
Yeah, no, absolutely. I think, and that's the reason why, Sandeep, in the opening remarks itself, we commented that, that our, current capital position is strong, as you can make out by the 13.39% of CET1 ratio. But we would continue to assess this and look at further strengthening the balance sheet, as opportunities arise. That's something that we have said upfront, and it's a continuous assessment that will be required, because of the reasons that you mentioned.
My second question, just one clarification. If a customer moves from MCLR to external benchmark, is it at this point of time a margin dilutive exercise? Thanks.
So, sorry, if it moves from MCLR to repo rate?
External.
Yes, it is margin dilutive. Yeah, it could be depends on, on MCLR at what rate the customer is. So if the current rate is lower, it would be at a lower yield. That does happen when, rates go down.
But no, the question is more specific at this point of time. When you look at your conversions which is happening, it would be at a lower rate. It is diluted.
Yeah.
Okay. Perfect. No, thanks.
Thank you. The next question is from the line of Manish Oswal from Nirmal Bang Securities. Please go ahead.
Yes, sir. Most of the questions have been answered. Only one data point. What is the excess liquidity sitting on the balance sheet on 31st March 2020?
So we don't, disclose that number separately, but, I think you can imagine in the current environment where, banks are lending so much to RBI in terms of surplus which is there. Given our strong deposit franchise, we have a significant, surplus, which is there. A part of that you can kind of see in the balance sheet, when you look at the cash and bank balances number that has gone up substantially compared to December and will be reflecting the higher liquidity that we have.
Thank you, sir. Thank you.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Thanks for the opportunity. I have two questions. Firstly, for deposit growth, our CASA deposits this quarter growth has been relatively modest versus what we have seen with some other private banks. So, has there been some churn from savings to term deposits, which has held up really well? And how is your account opening run rate since March?
On CASA deposits, like I said, we have kind of virtually completely removed our focus from the period end balance numbers. So if you look at both, current account and savings deposits, I think the YOY growth is, 6 or 7%. But I would, urge you to look at the daily average balance growth, which on the current account side is 17%. I don't think there will be, too many banks who would have grown at 17% the current account, balances for the year. On the savings deposit side, yes, I think, we are at about, 11%. We have been in that region of 10.5 to 12% kind of a range. We would like to do, better than that. And again, if you compare from a daily average basis, across banks, yes, maybe one bank, would have done higher than that. But generally, that's not a number which is, much lower than where the better banks are.
Okay.
And the other thing that you also mentioned, the retail term deposits have been doing extremely well. And as I mentioned on that, the rates that we have been keeping are the lowest amongst the private sector banks. So if you look at the cost of deposits, that has been, coming down for us, well. And again, we would pretty much be the lowest, cost of deposit, bank, maybe SBI would be lower. Other than that, we would be, there. So again, we look at not just the CASA ratio per se, we look at the absolute growth in daily average balance and the cost of deposit. And that is what has, over the last couple of years, helped us on the margin expansion, which we discussed, as a part of the earlier, question.
Right. And on the account opening run rate, how has that been since the lockdown?
On the account opening, I think it's fair to assume that, that the disruption, has, impacted the, all aspects of business, including the account opening. We are not given any specific numbers on that.
Okay. Secondly, on the mortgage, which is one of the largest segments for us, the growth trend rate has been different, not just in this quarter, but even in the earlier quarters. And we have been trying to compensate for them by growing the lab book. So, what is the growth of your housing loans? And secondly, are we seeing any customer churn from a housing book to other lenders given the rising rate differences?
So, on the mortgage portfolio in terms of outlook, I think, I talked about it in response to an earlier, query which is there. On, churning balance, transfer in, transfer out, I think, in terms of rates, our rates, have been, somewhat higher in the past. I think, as we speak, we have, brought down the rate a bit. So we should not be net losing, is what our objective, should be. And we would, try and gain in terms of balance transferring during this, period.
Okay. And if you can share the growth in the core housing loans, excluding LAP?
So if you look at the overall growth is about 12% in the portfolio.
Right.
I don't have a specific number on that, but it will be clearly be lower than that for just the pure home loans.
Okay. And lastly, we have given color of the moratorium, but if you look at slide 33 of the presentation, wherein we give the rating profile, 70% of the book is rated A- and above, and our moratorium book is around 30%. So, if you can share some color to where does this moratorium book comes from, how much from A- and above, and how much below that?
This portfolio that we have given slide 33 is, for corporate and retail loans in aggregate. And the retail portfolio, like we have given in the footnote, that is mapped on an entire product level. So if mortgage is rated, for example, A, then it will come in that A category. So it is not, customer by customer kind of rating profile for the retail portfolio. As I said, I think the moratorium which has been, asked for will be spread across the borrowers. We have not given any further details on the rating-wise split of the moratorium.
Sure. Okay, sure. Thanks, Rajesh.
Thank you.
Thanks.
Thank you. Ladies and gentlemen, we may please request you to limit your questions to 2 per participant. For any further questions, you may come back for a follow-up. The next question is from the line of Sameer Bhise from JM Financial. Please go ahead.
Yeah, hi. Thanks for the opportunity.
can you kind of give some commentary on how did the bank assess the requirement of the 27 billion COVID provision, or some commentary on stress testing the portfolio, or how do you think see the things shaping up? While obviously we know things are uncertain, but your approach to how you are looking at the situation.
So, indeed, we have looked at, various kind of, scenarios, and I talked about in my opening remarks in terms of each of the portfolios, what are the variables that we have, looked at. For example, on the retail portfolio, we have, looked at risk markers based on credit score, leverage, loan to value, as well as, the employers for salaried borrowers and other, such inputs, including, whether the borrower has, taken moratorium. So each portfolio, there is a specific, kind of assessment that we have done based on the analysis that I talked about, earlier. Indeed, there can be many more scenarios that can be developed. I think the fundamental assumption is around, when does the lockdown, get over, and then thereafter, what is the time it takes for economic activities to kind of, come back to the pre-COVID, kind of period. So those are the two biggest variables which are there, and that's something that we will continue to assess on a continuous basis based on the framework that we have put in place. The provisions that we have taken, it is not that it is exactly computed based on a particular scenario of stress per se. We have looked at various scenarios, and we have looked at various factors, and then taken what we believe is a provision to strengthen our balance sheet in the current times.
So I'm assuming that in your base case, this is the provision that you would want to make, and there's nothing incremental required, depending on the information that we have today.
So I think it's very, very difficult to look at it that way. So it is not that we would have upfronted all provisions required due to COVID and taken it on March 31st. I don't think that would be a fair assumption. Because it's not that we will not have incremental provision requirement coming in because of COVID in FY21, because there are so many scenarios that can be developed in that regard. This is a provision that, of course, we have looked at all the scenarios, we have looked at how things can play out, and then we have taken a provision to strengthen the balance sheet is how I would say, and I would not say that this is equivalent to the total provision required because of COVID.
Okay. Thank you. That's all.
Thank you. The next question is from the line of Nilanjan Karfa from IDFC. Please go ahead.
Hi. One question on cost. So, would you be able to help us understand, the rough split between, let's say, fixed costs to, semi-fixed and variable costs? And when I talk of variable, which is business linked, something on that will be really helpful.
So, again, it's very difficult, how each of the expenses are, categorized into fixed and, variable. I think there are a lot of, business-related expenses which are there. The ones which are absolutely variable at the end of the day would be, things like, say, sourcing costs. If you're paying X percentage for sourcing a particular loan, that is a completely, variable cost which is there, which will not be a very large number as you would appreciate. Rest of it will be a mix of, fixed and semi-variable. But then again, some of those costs, can be, managed as well, at these times. So we'll have to look at it, on a line item by line item, business by business basis.
Okay, but you want like to give out a little more color on that?
No, it's very difficult to give a number.
Okay, let me ask it differently. If you have to look at your costs, what would be your strategy in terms of how much of cuts you can take over the next 3-4 years? I mean, is that the kind of range you would want to look at?
On the cost, I think there are various things which are there. You look at, for example, employee cost. That is a large part. A lot of expenses are then linked to once the employee is there, you have the infrastructure cost, you have various other costs which are there. So the variables there are would you how much do you hire new employees? How much of attrition do you replace? What is the increment that we have for the employee? What is the performance bonus that you have for employees? So there are all of these variables are indeed there, and on the non-employee side there will be, like I said, technology, IT related expenses that will definitely continue. You have rentals and all of this. I am sure in the current context, all entities, including us, will look at various options on work from home and all of that. Do we really require as much of infra as we have? Can we look at rentals differently? So a lot of those opportunities will be there. But it's a fine balance. I think we'll continuously assess the time that we think it will take for the economy to get back to an even keel and for us to grow our revenues. And in the meanwhile, we look at all of these options.
Okay. Let me ask another question. Given howsoever the growth and economic activity pans out, you would want to keep your revenue growth above expense growth. That's something you will not sacrifice at all, and that would mean that you will also sacrifice margins if it comes to that. Would that be a right assessment?
So if for a particular quarter, expense turns out to be higher than revenue, we will not over worry on that. I think that is not something we should over worry about. I think from a longer term perspective, anything which is sustainable, I think our objective is very clear in the medium term, long term, is to grow core operating profit in a risk calibrated manner. For us to grow that, we will require revenue growth to be higher than expenses. That is the core objective. Mm-hmm. But at such times, it is difficult. For example, if there is no credit demand, if there is no growth, you assume in the June quarter, the loan book declines. It is possible that expenses will be going higher.
Rakesh, not a quarter. I'm not even bothered for the next 6 months or 9 months.
Yeah, in the medium term, absolutely. Revenues will have to be faster than expenses. There is no two ways around it. And as soon as any business sees, potentially that expenses can, start running higher than revenue, each business looks at that, aspect.
Sure. And just a bookkeeping question, Rakesh. If we have to exclude those two international accounts, what might have been the slippages this quarter?
Lower. It would have been lower.
Sequentially lower.
Obviously, we don't get individual exposures.
Okay. Okay. Thank you.
Thank you. The next question is from the line of Abhishek Murarka from IIFL. Please go ahead.
Hello. Good evening. Thanks for taking my question. So a couple of questions. One, in this moratorium that you've given to nearly 30% of your portfolio, can you give some sort of understanding of which product you would have seen a higher request or a preference for moratorium in versus others? The second is in your BB, as in business banking portfolio, would you be able to give some sense of industry level NPAs, average industry level NPAs pre-COVID, and any commentary around what kind of worsening you could see maybe from a 6 month, 1 year point of view? And third, on credit cards, again, if you can share some ballpark of, let's say, composition of trends between broad heads like, travel, entertainment, or discretionary, non-discretionary. Any sort of ballpark there would be very useful very useful. Thanks. Yeah, those three.
So on moratorium, I think, we have answered it earlier as well, that it is spread across portfolios. I think, clearly, portfolios where we would have a higher proportion of customers, under moratorium will be, commercial vehicle portfolio, some of the rural portfolio, two-wheeler portfolio, where we have given an opt-out, that we have given a moratorium by default. So there the percentages will indeed be, higher. Otherwise, it is, spread across, each of the portfolios. It's not that any portfolio is at a very low number, or anything is at a very high number, other than the ones where there is a default, moratorium being given. And as I said, that is about, 10-11% of our total loans. So that, of course, will be a large part of that would contribute to the 30% number, about 30% number that we, talked about.
Right.
That is on moratorium. The second question was on the double B and below portfolio.
Yeah, the business banking portfolio.
Okay. Yeah. The business, no, you said double B, so I got confused. No, on the business banking portfolio, actually till this March 31st, the delinquency numbers have been extremely low for us for the last, few years, and that, trend has continued till March 31st. Of course, now we have to see, how the current scenario impacts, that portfolio. The comfort that we have that it's a granular portfolio. It is very well, collateralized, portfolio. It is a portfolio where we have deep banking relationship, with the customer. It is not just, a kind of a term loan, portfolio which is there. So with all of that, we believe that the portfolio should do well. But again, COVID-19 is an unprecedented kind of a stress which is there. So we'll see how that plays out. But generally, we are comfortable on that portfolio. We don't have any industry-wide breakup there. Maybe in future we'll consider that. Abhishek, on the credit card, I don't have those numbers right now. Maybe separately we'll see if we can provide those numbers.
Sure. So just squeezing in one more question, very quick one. So overall contingency provisions, do you propose to keep them at a certain level, let's say 2% of loans or 1% of loans, or you want to increase them to a higher level? Any sort of target there?
No, we don't have any specific percentage in mind. I think, it will be a function of what we see on the portfolio, what we believe, should be, a comfortable, from a balance sheet strength, perspective is how we will look at it. The provisions we have, like I said, on the NPAs, we are extremely comfortable with the coverage level. Right. If anything, it's slightly higher than, where it normally would be. On this side, because of the current COVID-19, we thought we should take, somewhat higher provision on the standard loans per se. We don't have any specific number in our mind in terms of what we'll maintain it as.
So, at least in the short term, I mean, notwithstanding what's happening otherwise, you would not look to take it to, let's say, 2% of loans or anything, any such level?
No.
The contingency part?
No.
All right.
Unlikely.
All right. Thank you. All the best.
Thank you.
Yeah. Thank you. Ladies and gentlemen, we take the last question from the line of Prashant Kothari from Qtr4. Please go ahead.
Hello. Hi. Rakesh, from the international slippages that we have seen, just trying to understand why we are still lending to corporates who don't have any Indian connection, why we could not kind of wind up this earlier.
So, I think, that's something which is, clearly a learning for us. I think we have been, winding it down. I talked about a 30%, decline in the portfolio on a year-on-year basis between March 19 and March 20 for the overseas portfolio in the branches, which was not to Indian corporates and their subsidiaries and joint ventures. So, clearly, we are, going in that direction. And like Sandeep mentioned, we would continue to do that in a planned and calibrated manner going forward as well. And we take your point completely that maybe we could have done it at a faster pace.
Okay. And second question about our unsecured loans, credit cards and personal loans. How worried would you be about that or not worried because what a customer profile is? Give some sense on that would be useful.
One way to say is that, I don't think we would be worried more about the unsecured versus other categories of loans in the current, current environment, current context. Like I said, 70% of these borrowers are customers who have their liability relationship with us. I talked about the numbers on, the proportion of salaried customers. Within that, a large proportion is with, well-rated, entities as well. So overall, I don't think it's a portfolio on which we are, more worried than other portfolios, so to say. I think in the current context, things are uncertain and one would have, concerns across portfolios in terms of how things, shape out. That is true for the entire portfolio. but nothing, higher than that, I would say, for the unsecured book.
And just last question, Stephen. ICICI Home Finance book, I've seen that the book itself has declined about 10% from the low. What's happening there? Because this is some business that wants to scale up in a meaningful way, that there is some seeing the trend.
ICICI Home Finance, the loan book has come down. So we would have, done some, the company would have sold or securitized a part of their loans. Again, that is, from point of view of, their balance sheet and, capital management, perspective. So indeed, we would look at, growing the portfolio there, but it is within the context of, the capital which is there and the opportunities which are there.
All right. Thank you.
Thanks.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
Thank you, everyone. And, like always, we'll be happy to take your questions. While we'll not be able to meet, I guess, in the next few weeks, but we'll be available for calls or video calls at any point of time. Take care and be safe. Thank you.